planning beyond just the week and the month and the year, like planning next year. So it's more focused planning, intentional planning. The more you can do all of those things, the more you can actually achieve these things within life, and you can have success and significance together.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome back to Wealth Strategy Secrets of the Ultra Wealthy. Today we're diving into one of the most critical yet often overlooked aspects of building wealth: capital gains tax planning and exit strategies. If you're an entrepreneur, investor, or business owner who has built significant equity in real estate, businesses, cryptocurrency, or other appreciating assets, you may not have thought about what happens when it's time to sell. Too many people focus on growth, but not enough on how to exit efficiently, often finding themselves facing 20, 30%, or even 50% in capital gains taxes. A massive hit to their hard-earned wealth. That's where today's guest, Brett Swarts, comes in. Brett is a capital gains tax deferral expert and the founder of Capital Gains Tax Solutions. He helps high net worth individuals and entrepreneurs legally defer capital gains tax, preserve more of their wealth, and unlock new opportunities for reinvestment, all without being forced into a rushed 1031 exchange or long-term opportunity zone commitment. In this episode, we break down the biggest mistakes people make when selling their assets and how to avoid them, why 1031 exchanges, opportunity zones, and Delaware statutory trusts may not be the best fit, how a deferred sales trust, or DST, can actually provide flexibility, liquidity, and reinvestment opportunities across asset classes, and why debt can be a silent killer in real estate deals and how to eliminate debt burdens before they sink your portfolio. And finally, strategies for eliminating estate taxes and ensuring a smooth wealth transfer for your heirs. If you're planning to sell a business, exit a real estate investment, or unlock liquidity from an appreciating asset, this episode is a must listen. Let's dive in. Brett, welcome to the show.
Dave, good to be back.
Yeah, always good to see you and connect and everything. And thought this would be a great opportunity to bring you on the show again. I think it was over a year ago that you were on previously, but you've got a really unique solution that solves a very big problem many people have when they're trying to exit and avoid and defer capital gains. So I think your expertise will be really eye-opening to the audience. But as we begin, for those who aren't familiar with you, why don't we just talk about your origin story a little bit and how you got here?
Yeah, so thanks, and great to be back again. Started out helping people actually build. My parents, mom and dad, build real estate. I go way back in the Bay Area of California many, many years ago. And so I fell in love with real estate and wealth and entrepreneurship at that time. Fast forward, my brother and I, the first to graduate college. He was the first, I was the second. And I started to practice multifamily brokerage, helping people buy and sell real estate. So that helped me to create what I call a real estate investment advisory mindset and practice, which is helping people make strategic moves within real estate. At that time, it was mostly 1031 exchanges until we really learned the hard way that 1031 can be not just your friend, it can be kind of your enemy. It can be that Achilles heel that puts you in a position that's over leveraged, not diversified, not liquid. And that's where people can get in trouble, which we're seeing right now within commercial real estate. So that was 2009 when the market crashed. And so I went from making a little bit of money before that to nothing overnight. And if you've ever been there before where you're trying to figure out how to put food on the table, that's where I was, newly married, baby on the way, and scrambling down to the last $5,000. I went back to it. I remember, I'll never forget, I needed $5,000. So I had to call my dad and say, Dad, I need a loan. I'm out of money. I go, and I'm working these, side hustles. And that was what I think every good entrepreneur does. You get a side hustle to keep the dream alive. And so by day, I'd negotiate with banks and help my clients keep their properties. And then by night, I would work at Cheesecake Factory to help, get the lights on. So that was kind of the that was the 2-year journey financially, but I got to grow a lot, which I'm really grateful for, because otherwise I wouldn't have learned how to help my clients who are going through losing half or all of their wealth. I was going through trying to just keep a couple dollars, coming in to keep the family able to live, keep my wife home full time with our baby. So that's the background. And then fast forward, I learned about something that helped my clients escape feeling trapped by capital gains taxes, escape the 1031 exchange or overpaying for properties. This works for businesses, cryptocurrency, Bitcoin, stock, any asset of any kind. But really what we learned is how to unlock what's called truly passive income, which gives the person the ability to sell, diversify, and then free up their most valuable asset, which is time, right? Time to be able to spend with their families, time to be able to make an impact, time to be able to maybe start that new entrepreneur journey, right? That they feel called to start, or the new business they feel to start without having to feel trapped by the capital gains tax. And so that's what we do now. We unlock passive income plans, is a good way to think about it. We unlock new entrepreneurial journeys, and we do it through a tax deferral strategy when people have these big, massive, multi-million-dollar exits.
Yeah, something you said there really resonated, which is the life of an entrepreneur, about just really it's the time that you actually become completely responsible for your financial independence, becoming an entrepreneur and moving out of that W-2 role. And it's in times like that you actually learn what type of resourcefulness and resilience you have. And I keep trying to teach that lesson to my kids right now, that failing is okay. You need to fail fast and you need to learn. But I will tell you, you will learn so fast when you're in that position of running out of, your last amount of capital that you have, or that income is not coming through. And so as challenging as that might be, that's where the growth lies, right? The growth lies in the biggest challenges that we have. So appreciate you sharing that story. And obviously you've had a tremendous amount of growth. And I think it's really enlightening and illuminating, what you're doing for clients today. So I think, why don't we start really with kind of breaking down the problem, right? Who is it that typically has the problem, right, with a capital gains problem? You mentioned a couple potential clients that might be a fit, different asset classes it might be for, but who is really kind of a good fit for this, and what is the primary problem that they're looking at?
Yeah, well, the primary problem is people make mistakes when they don't plan for their exit and they don't define what it means to have to pay 20, 30, 40, or 50% of their proceeds in tax. Like, they just don't typically think about it. They're so busy building the business, investing into the Bitcoin, and building a real estate, portfolio or empire. And it's so much about the building of it. They don't stop to build what's called a capital gains tax exit plan. And so the mistake is they spend so much time on growing and not enough time on the landing. The plane has been cruising at a great altitude, and it's a rocket ship. It's taken off. It's a big company success. Well, how are you going to come back down? You saw Elon Musk, recently, about 6 months ago or so, that his technology, that robot that basically can grab the rocket and put it safely back into the dock there in Florida, right? Yeah. And you were like, wow, like, how incredible is that? Just think about that. Like, you could have been that rocket that's been up in space, just making all the millions of revenue, and you have this huge exit, and this rocket needs to come back down to orbit, and that being your capital, your wealth, right? And without like a robot to kind of grab it and put it safely back in, it's either gonna, it's gonna lose a lot of it. It's gonna lose a lot of its wealth, right? And so that's the problem. It's 20, 30, 40, or 50% of the total proceeds upon a sale is going to be taxed. And so this is known as capital gains tax and depreciation recapture, depending on what state you're in, depending on where you're at, right? And so as an example, we just helped a client an $8 million exit up in Massachusetts, exit a huge automotive business, right? That he had built from 100,000 of revenue to multi-millions of revenue. And he just exited about 60% of it. And he has another 40% for another piece of the pie here coming up in a later date. But upon that, we were able to defer and have an extra, 30, 35, maybe even 40% more proceeds working for him. And so we're kind of like that robot that helps to catch the rocket, put it safely down so that it doesn't, have to get cut by the tax. And so that's the problem. So the mindset here to focus on is having what's called a tax flow mindset, not just a cash flow mindset, right? Or not just a let me build it up and sell it mindset. It's like, how do I also look at this tax challenge that's going to happen so that I have this extra amount more proceeds to work for me? And the method that we use is something called a deferred sales trust. And that's our specialty because we believe it's the only proven legal flexible strategy that gives the purpose-driven entrepreneur investor what they really want, which is that truly passive income and the ability to also go back and be an entrepreneur, which is what they're really good at. And so when you combine those three things, you can kind of have a framework for kind of where we can take this conversation today.
Got it. And what are some of the other solutions? So you talked about 1031 is one of the big ones that people know about. What other options do people have?
Yeah, so 1031 exchange is one of them. People might have heard of opportunity zones. People might have heard of the poor man's 1031, where they're doing they're doing cost segregation, accelerated depreciation on assets they're buying. They could be doing oil and gas, something there. And so these are all different mechanisms to do deferral, right, or offsets in a given year. So those are some of the ones that people might consider and look at. Delaware Statutory Trust is another form of a 1031 exchange that people at times get confused with our strategy of deferred sales trust, but we also help people with 1031s and Delaware Statutory Trust exits as well. You just have to realize that 1031 world, just focusing on that for a second, it only applies to investment real estate. It doesn't apply to business sales or Bitcoin or primary homes, right? It only applies to investment real estate. Opportunity zones applies to everything, but it's typically a 10 plus year hold or greater before you can do anything with the capital. And they're typically building from the ground up, which if you have a great deal, you can do that. But a lot of our clients are ready to redeploy their capital somewhere for 6 to 12 months into something else that they want to go into. And they want to be able to diversify into multiple things without any timing restraints, which is back to the proven flexible strategy that we have. That's what people really want. They want the flexibility to make adjustments as they, take off this next rocket and they're going to go somewhere with that, right? So this is kind of why we like the deferred sales trust. Out of all of them, typically we find that to be the best fit for most of our clients.
Yeah, can you unpack that just a little bit more? So we have a lot of real estate investors here who have looked at 1031s and opportunity zones as well. So can you just talk through some of the limitations of both of those vehicles?
Yeah, one of the biggest mistakes is we've been taught that the 1031 exchange is basically the end all be all for building wealth within real estate, where you sell and you trade, and then when you die, you get a stepped up basis. And people and us, and I'm included, I'm a real estate broker by trade, and we've closed over $500 million for clients in real estate and DST transactions. And so we see it every single day. In fact, before I met and understood the deferred sales trust, what it was about and how it worked, I was doing 1031s. That's all we were doing, right? And so the mistake is that when you trade assets, if you're buying something that you normally wouldn't buy, if it wasn't for the tax, let the tax tail wag the investment dog, you're making a mistake, right? And that's the really big challenge with folks is you have poured blood, sweat, and tears to buy this deal that you had bought, to improve the property, to hold on to the property, be disciplined. And one mistake within a 45-day window when you have to identify can cost you, another decade of having to build the wealth back up or losing the asset. And so understanding that, what are you solving for? And I think it's really a three-step mindset, right? Tax flow, cash flow, and debt flow, right? And in a 1031 exchange, you have to replace equal or greater debt. So on this debt flow piece, the mistake is, I'll just go into more debt, and I imagine that debt interest rates are going to stay low forever, right? I had a client telling me that, they're never going to go above a certain amount. Obviously that's a wrong, it's a mistake to think that where interest rates have gone, and now the debt is sinking these ships. Right? The water of debt is just flowing over the top, even though the ship was cruising at a good speed, had good occupancy, had some increase in insurance costs, but overall the asset class, and let's say it was multifamily, was doing great. But now the debt is just sinking the ship because the debt has readjusted and now it's sinking the ship. So debt flow is so key. In a 1031, you have to stay equal or greater debt, which again is not great when the market's really hot. And we knew, I think most of us knew that the market was probably at a high point in real estate a couple of years ago. But again, if you're in a 1031 exchange, because of this 45-day, you're selling high and buying higher. And the worst part is you're selling and you're having to replace your debt. And now the interest rates go higher. And now everything you've worked for 5 or 10 years to get to this point is lost, or you're fighting with the banks to negotiate. So this whole thing is really the mistake of taking on too much debt with the 1031 exchange and the timing restriction. Again, and the way to solve this is to not use the 1031 exchange, right? To just go to a different path. Like 1031 is not the hammer that hits all nails, right? It is a hammer that hits a nail when everything lines up and makes sense. Whereas the deferred sales trust is kind of like that Swiss Army knife. It can do all those things. You can go into debt if you want to. You can go into real estate if you want to. You can go to oil and gas. You can go into Bitcoin. You can go to stocks, bonds, mutual funds. You don't have to go into debt, though. You can also just be out of debt. Right? That's key, right? And maybe you want to be more conservative while you wait for the market to shift, or like we're in a new election. We're in a new administration, right, from the election, and things are changing, right? And so what we did, our method was we sold high, got people out of debt, got them diversified, got them liquid, got them in a lot of debt instruments that are paying double-digit returns. And we've been waiting basically for this last couple of years. And we've been also buying as the market's gone down. We've seen opportunities. We've been dollar cost averaging. And that's the key, right? How do you get time back on your side to be able to execute in a way that just makes sense? That it's not rocket science when you have time on your side.
Yeah, no, that makes a lot of sense, Brett. And I've talked to so many people that have thought the 1031 was the great strategy, but as they got into it, they really found themselves in a pickle, right? Because they're trying to buy an asset under a short timeline, and that was well said, right? Which is the tax tail wags the dog, and you definitely don't want to be leading with that, right? Because you're taking the strategy and you're dismantling it right from the beginning. Doesn't make sense.
Correct.
So, heard of a lot of investors who've had challenges with that. On the opportunity zone side, totally agree. These are typically in markets that you may not want to be investing in real estate, and that long-term hold, of 10 years is, anything can happen in 10 years, right? So it's much longer. So why don't you first, before we really break down the DST and actually how it works and functions is where I'd like to go with that. But before we do that, I do want to, have you explain the distinction between a lot of people will talk about, Delaware statutory trust versus a deferred sales trust. What is the difference?
Yeah, so a Delaware statutory trust is a form of a 1031 exchange. And let's use an analogy of Blockbuster is 1031 exchange, and Hollywood Video or the local video stores, the Delaware statutory trust. It's all a part of that old school family of ways of selling and exiting and deferring capital gains tax on real estate. By the way, they have their place. They have an amazing place. One of the best things about them is for certain deals, you can replace what's called debt over basis. And debt over basis is a big challenge for a lot of folks who have done cash out refis on their properties and have little to no basis remaining. And they've been tax free in the year that they did a cash out refi. But upon the sale, it's going to be recaptured as ordinary income tax, which is the highest rates. So it's a big challenge with these cash out refis. And so we do use the Delawares in a unique strategy. In fact, what we offer here at Capital Gains Tax Solutions is all three options: the Delaware Statutory Trust, Deferred Sales Trust, and 1031 exchanges. We have a whole best 1031 exit plan that gives you the options. And we work with advisors who also execute on those Delaware statutory trusts. So we work as a team there. But the whole point of it is you're basically trading your investment real estate property equity, and you're moving into an interest into a portfolio, typically of maybe 1, 2, or 3 properties. It could be larger apartment complexes. It could be an Amazon warehouse. It could be industrial buildings. It could be student housing. It could be a number of different asset classes within real estate, but you're 1031 into a passive, non-recourse debt, no control, no liquidity, no diversification, okay? And it's tied up 5, 7, 10 years, just depending on the deal. Now, most of these are paying around 5%. Maybe you get some of it 6, maybe 7. I've seen most of them around like 5%, which for a lot of folks is not really a game changer for them, right? It doesn't unlock the truly passive income. It unlocks no more toilet trash, termites liability on their own, which is important, right? This is a part of it. But we found that you need to be getting to 10, 11, 12%. And when you can do that within your cash on cash return on your equity, it starts to increase not only your monthly cash on cash, but your ability to obtain what's called a TPI number, which is your truly passive income number, where you can retire, no toilets, no trash, no termites, no problems, and you just have the money coming in and you do nothing for it. You don't have to trade any of your time for that. So that's really the key distinction with the Delaware Statutory Trust and the Deferred Sales Trust, is we can achieve such higher returns, okay? So that's the Delaware Statutory Trust. It only works for investment real estate, does not work for Bitcoin, business sales, primary homes, whereas our Deferred Sales Trust works for any asset of any kind, and we can achieve double-digit returns. We have total flexibility. And oh, by the way, if you like that student housing property, well, the Deferred Sales Trust, we can invest into that same deal, right? We just might, on a $10 million exit, we're not going to probably put all 10 million into the one deal. We might put $1 million into that deal, and we might choose 5 others: an industrial, a mobile home park, multifamily, maybe some debt. We might diversify within commercial real estate. So that's the beauty of our strategy, is it doesn't have to, go all in all at once into one deal.
Hey, it's Dave Wolcott here. Let me ask you something. Are you tired of the same old financial advice that leaves you spinning your wheels? If you're ready to discover the real secrets the ultra wealthy use to build unstoppable wealth, then I've got something just for you. My new book, The Holistic Wealth Strategy, is your ticket to learning the proven strategies that the top 1% don't want you to know. This book isn't just about money. It's about building a life of purpose, freedom, and lasting impact. And I want to give you a free copy. Visit holisticwealthstrategy.com and get yours today. It's time to level up your financial game and create the future you deserve.
Yeah. What's the threshold for setting up a DST, right? If someone's having a capital gains event, is this something they should think about at the $1 million mark or the $5 million mark, or what is it?
Yeah, $1 million net proceeds, $1 million gain is a great way to look at this for the Deferred Sales Trust. But it makes it really easy to do the math, as long as you don't need or want to spend all of the money all at once on your personal stuff. So most of our clients will set it up. We just recently helped a client a $16 million exit out of Oregon. They sold a dental practice, multiple practices, and they're setting up in small incremental payments starting in about year 2. But all of the amount, we have an extra about 35% more working for them, which is really neat. And so we defer their income, defer their capital gains tax, we're deferring their income tax, and then they're going to slowly pay payments along the way. So that's a good example of how the Deferred Sales Trust works, and why if it's big enough, it has enough gain for enough tax to defer. So $1 million net proceeds, $1 million gain.
Got it. All right, why don't we walk through the process, and let's take the example that I'm exiting a business right now for $10 million. That's the actual gain. What would the engagement look like in terms of working with you guys? How would you set it up? How would you structure it? What's the process?
Yeah, so first of all, we work on a conditional engagement basis, meaning you don't pay anything unless and if you use the Deferred Sales Trust at the closing. For any reason it doesn't close, or you decide not to use it, you don't owe us anything. So we take all the pressure off of that. We do have the best 1031 exit plan, by the way, which gives you a regular 1031 exchange option and also the Deferred Sales Trust. That's around $2,000 upfront one time. But again, that gives you the 1031 service as well, which is important. Okay, so step 1 is simply a discovery and understanding what your dreams and goals are for your exit, right? If you don't have clarity on what and how, where and how you want the funds to be invested, and what the intent of the cash flow from that is going to be, then we've got to start there. We've got to really craft and start to build out based upon your unique goals and your challenges that you're trying to overcome. And then we're going to, step 2, look at the deal itself, understand obviously your tax liability, understand what the debt over basis is, or just kind of I call it the x-ray of the entire sale, right? Next step would be simply setting up the trust, and the trust being inserted into the language of your purchase and sale agreement, asset purchase agreement, or however you're selling it, depending on how you're selling it. And we'll work with your legal team, M&A advisors, or real estate brokers and agents. We also have title companies that we're working with for all of these kind of things. And that's all of the back end legal work and process. Another part would be just investment allocation and understanding, like your risk tolerance and where and how you want to invest the funds. What are your cash flow needs? What is your vision what's your mission, vision, values for your family and for your wealth? What does this look like in 1, 3, 5, 10 years? What are your perfect life numbers, wealth wise and cash flow wise, 1, 3, 5, 10 years? and how can we structure and architect this entire plan to serve you for those goals. And then from there, we close when funds typically hit Charles Schwab, and you're issued a promissory note and an interest rate on that note. So if it was like a $10 million exit and you were selling in New York, New Jersey, or California, and you would have paid $4 million of tax, the trust has $10 million and it owes you the $10 million. And then it simply pays you back over time. And we would say you set an interest rate at 9%. So it's $900,000 per year. We're going to go invest the funds. And our goal is to try to earn, net of fees about $900,000 per year. Not a guarantee. We got to go earn it, and then pay you out per the promissory note. And you might take partial interest payments or full interest payments, and then you'll pay tax on what you receive. And you might also take some principal payments and pay some tax there. So everything is dependent upon how and where the client wants to invest the funds and how and where the client wants to receive payments back from the trust. And then we dial it in. And once we dial it in, we just follow the plan.
Is your team made up of CPAs and RIAs?
Yes. So our team, when I say our team, there's multiple parties here. There's a tax attorney that does all the legal work. We are the trustee, and then we work with third-party groups that are RIAs or financial advisors. And so we really build a team, and we help to quarterback on behalf of the trust, the entire team to serve it. But our one company is a trustee company.
Got it. But it's really a collaboration with the experts to put the whole thing together.
Correct.
Yeah. And how do you guys make your money? How is that structured?
Yeah. So as a trustee, we make money based upon the AUM into the trust. So it's about 1.5% to 2% on a recurring basis. And that typically involves and includes the financial advisor as a part of that.
Got it. Are there any good asset classes you've been following or people have been, requesting as we head into 2025 here?
Before I answer that question too, there's also a one-time legal fee that's paid to the tax attorney at closing, and that's about 1.5% of the gross sales price. As far as the assets and real estate or the stuff that we like what our clients like, or let's put it this way, we're agnostic to asset class in the sense that clients who've showed up typically know how to make money on their own businesses, their own real estate, or their own stuff, which is great. And we are the facilitator of the trust to make investments. Personally, I like real estate because this is what I grew up in. I like mobile home parks. I like multifamily. I like industrial. I really like debt these days, though, and loaning on real estate and getting double-digit returns, 10 to 16%, depending on what we're going into. Some of these are 2-year lockups. Some of these are 30 or 60-day lockups if you want the money back, and paying either monthly or quarterly with groups that have never lost a dollar, that have an excellent track record. So those are some of the things we like on the debt side of things. And then we've been buying some multifamily because we've seen some distress here in the last 6 months, especially with some assets that are 20, 30% off of the market peaks. So, and of course, we always like value add or something that we can come in and force some appreciation through improvements of the property and the community, and to drive up the rents at a fair way to increase the value for the investor. So those are some of the things. So nothing really changing there. I have clients that go into Bitcoin. I've seen them wanting to go into Bitcoin a little more recently here as a shift. We're looking at some oil and gas opportunities as well for maybe kind of the first time. And but yeah, those are kind of the main ones.
Actually, that brings up a good question: is how do the tax benefits work inside of a DST? Can you still get those active income offsets to the person individually, or is that aligned to the trust, and then the trust takes advantage of it?
Yeah, it all depends on how we structure it. If the trust is joint venture partnering with somebody on an investment opportunity, as opposed to the trust going directly in to those investments. And so each individual deal and circumstance will vary, but we do like the strategy where if you have clients, build multifamily or buy multifamily, and let's say there's some depreciation that can flow through, the way that we can structure it, they can receive a majority of the depreciation the way we structure it, which is pretty neat by partnering with the trust. So yeah, we have some unique mechanisms that unlock the ability to make more than just the promissory note of 9%, as well as to get the depreciation to flow through to them on a personal level.
Yeah. Yeah. Because unique to oil and gas, you have to be a general partner in the deal to have those active losses flow to you. So got it. Since your background, right, is in real estate as well. I mean, can you give us a little bit more of your feel for 2025 in terms of the real estate market, interest rates? What are you thinking right now?
Yep. Last year was extend and pretend. A lot of people were, the tide had gone out and they were skinny dipping, but they were able to, grab a towel from the bank to just, hold their spot and act like, things are okay. We saw a lot of capital calls. We saw a lot of people, even hear people giving keys back to the bank. Not a lot, but some. And we think this is the year where there's no longer any extend and pretend. Like banks will be, pressing forward. Capital calls will increase, or properties will go back to banks, and the distress will be there, and opportunities are going to be around. Multifamily, especially, there's a ton of people who overpaid for multifamily. That's one we're keeping a real close eye on for opportunities. So that's what we expect. We expect debt to continue to be a great, excellent way for cash on cash return. We had a client exit a $2.5 million asset right before interest rates jumped high a couple of years ago. And we were able to increase their NOI from 120 to 190 and diversify. And most of what we did is we went into debt instruments. Their ROE was about 3 to 4%. And we were, 8 to 9 net of fees with what we were doing. And so that was just a huge win for them and their family. Unlock their time. So debt is going to be a big focus. Distressed opportunities or discounted real estate is a big focus. And I think there'll be excellent opportunities, especially in multifamily.
Yeah. Any other tax strategies that you're preferential to?
No, I love a 1031 exchange when it actually works and the deals make sense and you can buy a deal that you want to buy. Our 2.0 version eliminates estate tax. Without any charity, life insurance, or gifting required. So the other thing we're focusing on is not just capital gains tax; it's the death tax, which is a big challenge. 1031 on a stepped up basis doesn't solve for that when you get that, and so you want to find ways to eliminate the estate tax. And so we have a way to do that. So I think just taking the conversation, it's not just capital gains tax solutions; it's really estate tax solutions, and finding creative ways to offset and to eliminate. Actually, not even just offset, but literally eliminate the tax through structuring and sales using our 2.0 version versus our 1.0, which just has some slight differences there. But that would be something that people, I think, just really need to be focusing on, because there were 84 to 100 trillion transferring in the next 15 years, the largest wealth transfer in the history of the planet by the baby boomers, 10,000 turning 65 every day for the baby boomers in the U.S. alone. And there's about 80 million in the U.S. alone. And 50% of all wealth in America is tied to high-end primary homes, businesses, or commercial real estate. And so you got this big challenge of this wealth that's transferring, and people are going to get crushed with the tax, or they're not going to do the planning. It's going to be inside of the taxable estate, and then they're going to be forced to sell and pay 40% within 6 months of passing. So these are all the things that you want to be aware of and solve now, while you're still alive, while your clients are still able to make sales now, because once you pass, the death tax just is triggered and you're going to get hit. So we want to solve that for people right now.
What are you most excited about this year, personally or professionally?
Yeah, I'd say the time that I can spend with my family traveling. I'm going to Guatemala in 2 weeks with my daughter, and then we're going to Uganda a few weeks after that with the whole family. And we're going to be doing helping some MVPs, putting some clean water wells in, and just making these memories with the kids before they're all 18. Our goal is to get 1,000 extraordinary days in 100 unique locations before our kids are 18. And these are the best times to be doing it and not waiting. Doing it now, the things that we think about, you just plan it and go do it, regardless of the business and all the demands that growing a business, being an entrepreneur has. We just focus on doing those things. So those are for sure my family, spending time with my kids and my wife.
Awesome. Yeah. And I know you have a big family, Brett. So how do you manage your greatest asset, which is time?
Yeah, great question. So be very intentional, right? So I've got some amazing coaches on this that have done and really have a roadmap for how to be intentional with time and planning and accountability along those lines. So, one thing that's helping me, take a mindset of time is short is a short little Billy Graham 5-minute sermon on YouTube. It's called Time is Short, and you can look it up. And every single day this year, I listen to it. I listened to it just about an hour ago, just for 5 minutes. And it just talks about time and how short it is. And, what is your life? It's a vapor, right? It appears for a moment and is gone. And he talks about how when he was 20 years old, if someone had told him how short life was, he wouldn't have believed it. And how he just like, I want everyone who's 20 just to know how short time is. And so just that constant reminder that the things that we should be doing to do it now, like do the thing now. And so that really helps with the mindset and the reminder. And then I would say just actually planning. So planning beyond just the week and the month and the year, like planning next year. So we're already planning our next year's trips, right? We're mapping out our entire family calendar and what we're going to be doing. And we're planning things around what we're going to be doing with the family. And we have goals around those kind of days. It's not just, it's more focused planning, intentional planning. The more you can do all of those things, the more you can actually achieve these things within life. And you can have success and significance together. You can be an entrepreneur and have a thriving family. I also bring my kids with me everywhere, as much as I can, everywhere I go. So I went to a conference, a veterinarian conference about a month ago. And the last minute I said, well, why don't I bring a daughter with me? I have 4 daughters. And so I sent a message to my friend, he had an extra ticket. And so she spent 2.5 days, at this 25,000 people veterinarian conference in Orlando, going around, meeting the vendors, talking with them, petting the dogs, looking at all the different technologies and stuff. And she's 11 years old and she's a core memory. And so I brought her with me. And then my daughter going to Guatemala. We're going one-on-one. It's my oldest daughter. And then I had a video shoot with Kevin Harrington from Shark Tank. And so I brought 2 of my daughters to be my video team to take, social media, different things, pictures and all the stuff. So I think you got to figure out ways to incorporate. Now, we've been able to do that on a high level because we homeschool our kids, right? We don't have the traditional school system or the schedule or all of those things. And so we really plan and build our life with our family, and school is secondary. I think most people's school is like the number one thing and it's the end all be all. Well, we educate through an entrepreneurial approach, right? And it's turned out phenomenal. We're public school kids growing up, my wife and I, but we found that this homeschooling is probably the single best thing for our family dynamic, our time, our energy, just the flow of how we connect and with everything in our world. We also do jujitsu, right? That's a big thing for us as well. I do jujitsu. All my kids do jujitsu, which is a big part of mental discipline and emotional discipline and working out and extending beyond. I call it the little mini grit factory, right? Talk about resilience and resourcefulness, right? There's nothing like jujitsu. I think a few other sports offer it on a high level, but jujitsu for me and our family is just an incredible way to build that grit, build that resilience, and be able to be in the moment. I think that's another piece of this here too, right? When you focus in like an intense way, I think it's a saying that you exhaust the body to tame the mind, right? And so how do you exhaust the body? Well, part of that's working out, but if you can even do it on another level with competition, playing basketball growing up was a great way for me to do that. But in about an hour and a half, you can really get a super intense way to exhaust your body and tame your mind to be even more present. So I guess it's 100 things I can keep going, right? These are, read, pray, meditate, pray more than you think you need to. Go to church on Sundays, make sure you're feeding your body the right things. I'm on a health fitness program now where I have nutrition all laid out for me every single day of what I'm eating, tracking the macros, have a coach for that. There's not one single thing. It's probably, again, 10 key things, but all of these things help to get the family all lined up.
Yeah. No, love it, Brett. Yeah. I've got a big family as well. And such a great one that you threw out there by getting your kids involved. And, we got our kids involved at early stages to, our first single family rental that we did. And they got involved from everything from, painting it and fixing it up and understanding how it works to sharing the business financials. And to your point, it was interesting. Actually, just in December, I brought one of my daughters to a conference that I went to, and she got to kind of walk around, meet some people and everything. Yeah, help with some of the social media. And then we went to visit one of our properties, and she actually met the real estate broker there,
who was a completely, kick-ass real estate broker that was just doing really well and inspired my daughter so much that she's actually literally getting her exam and her certification right now. So it's like, sometimes they just get that spark, and you put them in the right, in the right environment, and not to mention you get to have time with them.
Spot on. Love it. I love that she's getting her license and getting going on that.
Yeah.
Taking action, right? You're exactly right. Just put them in the right environment. It's not rocket science. Put them around great leaders. Make it a community effort to build into your kids. And, it's actually simple. Just, you got to be intentional about it.
Yeah. 100%. Well, Brett, really appreciate your time. And if people want to learn more about, capital gains and how they can defer those, what is the best way for them to reach out to you or learn more?
Yeah, so a couple things. You go to brettswarts.com and it's access all of our links to the best-selling book, Building a Capital Gains Tax Exit Plan, Capital Gains Tax Solutions, the best 1031 exit plan, all of our social media, all the social media stuff that I have. You can also just go to Amazon and pick up the book as well. It's called Building a Capital Gains Tax Exit Plan. Again, if you have Bitcoin, business, real estate that you're selling, we'd love the opportunity to sit down with you to see if it could be an amazing fit. No cost, no obligation, consultation call. Just go to capitalgainstaxsolutions.com to apply for that call. Download our free ebook is there as well. We have an ebook on all of this. Appreciate everyone out there, and thanks for having me, Dave.
Awesome. Thanks, Brett. Appreciate it.
Hi, everybody.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.